to the comments section we go. So for this video, I'm inspired by a comment that someone left me on a video I made about ETF diversification needed in your portfolio. And this question really has to do with, essentially, would my portfolio truly look the same 30 years from now when I'm 65? So it's a great question. It's a fun question to unpack. Happy to do it especially for a regular contributor like Hamilton RB. So let's get into that. And then we got some tabs at the top to also help sort of flesh out, especially what you can see from the title, which is why I likely won't change my future income-based 100% equity covered call ETF portfolio. So Hamilton RB writes, I'm going to suggest a future video topic, and I will even give it a name to make your life easier, my 65-year-old portfolio. It is one thing to suggest what works for you now as a young man, but it would be interesting possibly after getting your parents' perspectives to suggest what your portfolio might look like in retirement, taking into consideration age, risk aversion, diversification, need for income, and some growth, and with a passive attitude, because as seniors, I can tell you that travel, golf, cigars, and Coronas are far more important than watching my portfolio. So, like I said, fun question to unpack, and also judging by the upvotes for people who were reading this also are interested in this question as well. So, no problem. First off, we gotta nail down what exactly is my portfolio strategy. What is my portfolio? Well, I believe in investing in a 100% covered call ETF based portfolio. What is that? It's what we would call it's part of a style of investing called income investing for income, meaning instead of investing, say, for potential future gains, you're investing for essentially, it would be you're investing for cash now versus cash later, which is a total return approach. Investing in a low-fee index fund like an S&P 500, a fund that you won't touch for 30, 40 years, and you just let it compound over that period of time. Whereas I'm investing for getting a higher, essentially, distribution, higher dividend every single month. I currently reinvest all that, but I also want the flexibility to extract that income and use it for other parts of my life to help enhance quality of life. That really is what this strategy is about. Flexibility to turn it into a total return strategy, or use it for quality of life to fill the needs, supplement costs, or for retirement, right? So pay off a mortgage, phone bills, grocery bills, whatever the case is. That's really what it is. And I believe that we can use this strategy to get around a 10 to 12% yield while also getting some capital appreciation at the same time. So it tries to hit an equilibrium of like, what is the max yield we can get with the max potential capital appreciation, right? And I honestly think like 2024 has been a really surprising year to experiment with this kind of strategy, and I think it has shown its true potential, and it's great to see because as we go into the community tab here, which I just posted the morning of making this video, how this strategy, like this is me right up here above the NASDAQ, above the S&P 500, total returns. That's price appreciation and dividends all included. Maybe earlier this year when it was really close, I thought, well, with time, I'm just not going to really say much about it, but about the performance. But now, like, I'm highlighting the performance much more now because we're so deep into the year that there's the potential that this does actually beat the market this year, which is not a typical thing. Cover calls are not meant to do that. So highly dynamic. So we'll see how that goes, but that's essentially what I'm trying to do. Get maximum of both in equilibrium, right? If I go for maximum price appreciation, I'm into a low index fund total return strategy, S&P 500 style. If I go for max yield, well, sure, I'll get a higher yield, but my price appreciation will be basically nothing, and there's a chance that my actual principal could kind of wither away. That there is a trade-off depending on how much you go in either direction. But I'm really trying to strike a balance there. Okay, so I've basically, in a nutshell, tried to give you all what it is I'm trying to do, the kind of portfolio I'm trying to build. So in the middle part of this question here, it's basically asking, what works for me now as a young man? Can it really work will it really work for me in the future? Well, most of this audience is either near retirement or retired. The vast majority of you are sort of in that wheelhouse of that stage of life, basically. And so if it's going to work for you all, then, it's going to work for me too. Granted, for me, that's a 30-year question down the line versus for many of you out there, which is a right now need or a question that you're asking yourselves. But as you can, I'm sure, judge by the title of my video, I'm absolutely committed to this for the long term. And I'm also invested across every sector, all the indexes. It really is an everywhere, everything, all the time kind of strategy. I have winners in the portfolio. I got losers in the portfolio. These are ETFs that invest in ETFs. They're very broad-based. They invest, like the kind of diversification that this question came out of, I address. Let's go back to videos here. I address diversifying across strategies and asset classes and fund managers and leadership experiences, in geography as well. Like that video does break down, if you really want to get that much more in depth. If you're kind of newer, beginner, then honestly, I think for a lot of people, they don't need that kind of level of diversification. I'm just a nut when it comes to that, and maybe a little bit psychopathic with diversification. I don't care about overlap. But having a variety of diversification will also just help me in time, really figure out what kinds of diversification is more important and which ones are less important. Then I can kind of maybe attune the strategy a little bit more and also be able to share that knowledge with all of you. So I pay more attention also because it helps with sharing that knowledge with all of you. The way I invest now, I totally envision myself investing in it for the long haul. Granted, I guess if you want to call it risk, what kind of risk can I take on today? Well, it's true. I'm younger. I got time to recover from any kinds of shocks. I have a really secure job that if my account went to zero, it would suck and it would be devastating, but it wouldn't destroy me. I could build that back from scratch, albeit that would suck to do. But again, I can lean back on my job. But when I'm 65, there won't be a job. There's going to be my pension and my investments, and maybe some other cash flow mechanisms that are at play. But I think this is a powerful strategy. And I do believe markets will rise over time. So I think from that sense, I don't see it changing. Maybe new knowledge comes in hand that helps enhance the strategy. Some other kind of play on CoveredCall ETFs that I just haven't been developed yet, or could work well in conjunction with. Like it could be CoveredCall ETFs plus something else in there, but for now, it's 100% CoveredCall ETF based. Now, for the portion of like my parents' perspective on it, and I'll try to keep this as brief as humanly possible here, but it's quite varied. My dad, huge into real estate, never really interested in say the stock market. Well, I wouldn't say not interested, but he really made his bread and butter with real estate over the decades and done really well on it. Honestly, he doesn't need to diversify because he loves what he does, and has done well with real estate. It's very similar to someone, if you're someone younger watching this video, like a Mr. Beast type, like one of the goats when it comes to YouTubers, someone who really loves making videos, reinvests 100% of everything he makes into all the videos. There is no diversification. If you love what you do and you're good at it, you honestly don't need to diversify. It's only really when you want to you want to be a little bit more hands off, or maybe you're unsure, you're newer. That's where diversification really, I think, it matters more for those people. So for myself, like, I really enjoy teaching covering CoveredCall ETFs, and I just think they're an easier form of investing than stock picking. I no longer have the time to analyze companies, stay up on the quarterly reports, discount cash flow methods, Tweed factors, and Graham equations. I just don't have time with that. With 3 kids, married, full-time job, I got to make my life a little bit easier somehow, and I've found that through ETFs. So for me, my motivation, it really just comes down to time. Where are my time constraints? I still want to participate in markets, but I don't have the time to continually analyze individual companies, stay up on them. I'd rather just invest across everything, and regardless of winners or losers, I believe markets will rise over time, and so will these ETFs. So for my dad, real estate all the way. Mom, totally different. Didn't buy her first place until she was 55. Didn't start investing in the stock market until she's 60. I actually manage her portfolio. I didn't take that on until maybe about a year ago. Got her invested in CoveredCall ETFs, and really it's to just give her some more breathing room. She ended up selling her condo after owning it for 5 years, did really well on it, sold it in 2021, retired, invested that in a mutual fund. I was really new at investing at the time. I didn't want to take on any kind of responsibility with anybody's portfolio, even though I was like super interested. I was reading all kinds of books about investing. I didn't want to, inflate that ego, self-ego. I knew that there's no way. I'd feel so bad if I made mistakes. Well, I still feel bad if I made a mistake that would cost anybody their investment, but especially my own mom, like the woman who raised me. So I do manage it for her, and she's got no interest in it, so she's just totally hands off, just wants to participate. And basically the attitude is, as long as the check don't bounce, I'm cool. Just keep providing it and keep tabs on it. Every so often she'll come to me with a request, and we try to make things work with her current investments, because she is in a position where decumulation, especially more towards retirement, that you hear that term a lot more with CPAs and financial planners, to decumulate when you are older and take advantage of those funds. But just with the amount she has, it's more important for her to maintain and preserve that initial capital, have a little bit of it grow, and still get around a 14% yield. So that's more important for her. And we're going to really only be able to do that through equity-based mechanisms. Okay, and then there's my wife's parents, who just recently moved to a warmer climate. And then my father-in-law, who avidly watches these videos, right? He's learning more about CoveredCall ETFs and becoming a little bit more comfortable in investing in the stock market. And so I got in my own family, I got a wide variety of just different levels of experience, and they're all in their 60s. I mean, my dad is still the only one working, and he currently is taking a mini 6-month vacation to just kind of test retirement. But everybody else, my mom, my wife's parents, they're all retired. So again, active conversations, like we're really pinging ideas off of one another about what if scenarios, at my age, at their age, and it really is it's a mutually beneficial conversation as right, I can kind of pick their brains of like what are some of the things they're experiencing, feelings, thoughts, with their ages that they're at, and how I can prepare for that, mentally speaking, I guess. Okay, so that's pretty long-winded for that section. Then we get into risk aversion. I really already touched on diversification. The only kind of diversification maybe I'll speak about is, right, I haven't talked about things like bonds. I haven't talked about gold. I haven't talked about crypto. So I'll give you a quick rundown of just diversification, ETF, or call it stock selection. It is more important to me to figure out what I don't like to make it easier to choose the things I do like. So I find with most people are more willing to vent their complaints than their attributes or the thing, or telling other people like what other people are good at. They would rather complain. That's just human nature. So I will use this to my advantage, to make my life a little bit simpler. I know that if I find it easier to pick out the things I don't like. So for instance, different asset classes. I'll never invest in bonds not because actually they underperform equity markets, but I have a higher opinion about the fact that our governments just spend oodles and oodles of our money like crazy, like it's going out of style. I don't want to be giving my own government my money, even though I'll get, say, a guaranteed return or a guaranteed return. They're just going to spend it on some, omnibus crap sandwich. Well, we don't like have omnibuses here, packages in government, but essentially whatever that equivalent is, it is like that. And so, nope, no, until I see more fiscal restraint, that will be a conversation for later. If I could see a proven track record that our governments could handle debt better, because honestly, it makes no sense that we as individuals have to handle debt one way and they handle debt a totally different way, and that really throws off that supply-demand balance that markets experience. So I do. Anyway, bonds, again, long story short, that's a no. Gold, nope. Essentially, whatever I invest in, it's a Warren Buffett principle. It's got to be like a farm. It's got to produce something at the end of that. So gold doesn't do that. Crypto doesn't do that. Now, I have a dual perspective on crypto. As an investment, I don't like it. But as a use case, I actually think there's some pretty good arguments for being on a Bitcoin standard that are really interesting. There is a book that I read called Thank God for Bitcoin. Really interesting. 75% of that book is about the history of money. 25% is about the use cases for Bitcoin, really calling it a more moral money. And that book really just opened my eyes to, like, I fully understood after that book, like, how governments use our money, fiat currency, money by decree, and how our style of commerce, well, not commerce, but just the system of money we use always fails 100% of the time. So the book goes through that. It's actually a pretty easy read, but if you're really wanting to understand how money has worked throughout history, how it repeats itself over and over again, pretty good book from that perspective. Okay. And anyway, one of the main arguments the book makes is that when you have a scarce resource and you use that for currency, people's behavior changes naturally if something is scarce. So if departments are competing for Bitcoin to spend on whatever, you're going to make your department as efficient as humanly possible with the least amount of money, like the least amount of waste possible. And I don't think I'm going to get anyone in the comment section arguing that there isn't waste in government. There's plenty of waste in government. So from that perspective, really like Bitcoin if it could evolve to that point. But I also just don't see the use cases in our own lives currently. Like there is no, like it's not like I can currently live without Bitcoin. I'll invest in or invest around like the technologies for it or the things that impact it if I feel like we can't live without it. That's why I like energy. That's why I like utilities. That's why I like banking. I like really big, boring, like dividend paying style sectors, industries, because we can't live without that stuff. We need it for absolutely everything. So that's my take on, say, diversification across asset classes. Hopefully I'm not forgetting anything there, but essentially it's got to act like a farm. I invest in things that act like a farm. They must produce something. And then just need for income. Okay. I went into the dividend. What is this? This is a dividend calculator. And I put in a couple of things here. Let's see, monthly. So distribution frequency monthly. This I'm just calculating my TFSA. This is the portfolio that ideally is just sort of the backup portfolio to help out if in the case of an emergency. But the idea is just to keep reinvesting. So the starting principal, we'll call it 122,000. I've almost maxed out my TFSA. So at this point, we'll just call it $7,000 a year. My rough yield is around 12%. Let's go low. Expect an annual dividend increase of 3%. Even though here in 2024, it's gone up 14.5%. So there's going to be these years of it's going to be bigger. And price appreciation 3%. Even though my price appreciation in 2024 across all my portfolios is around 13%. I want to say between 13 and 14%. So I'm keeping my expectations way, way low because we're not going to have, every year is not going to be like 2024. There's no chance of that. So keep expectations low. And what do we get? Well, in about 10 years, I'm going to have, what is that? Like just my TFSA alone will be making $72,000. And then in 13 years, 115,000. I mean, in 13 years, I'll be, how old will I be? 47, 48. I mean, I don't hate my job. I actually like what I do. So right now, and I've been working the same thing I've been with the same company for 10 years. I still enjoy it. It's a dynamic workplace. So I'm not in this big panic rush to get to financial independence. I continually chip away at it because it's important to me. And I want to be in that position where I can literally choose at the drop of a hat to say, I'm done. So for me, retirement at 65 can come a lot sooner. So if it comes at 45 or 48, that's a great range. And I mean, as the channel continues to grow and other opportunities open up, I'm sure, right? Like this channel will produce more as well. So this number could even shrink to say 7 years or 6 years, all depending. And again, this is just my TFSA. I'll talk about in my next video, my portfolio overview, like what my non-registered account is going to look like. But essentially, that is at bare minimum what my TFSA will look like over time. And going forward, just as a bit of a tease for you guys out there, we got the November CoveredCall ETF AllStar tracker. I'm going to be adding two new tabs, which one is going to be my portfolio. So you're going to see it in live all the time. Anytime you want to look at it, it will be live. And you'll also be able to access my trades. So what have my contributions looked like over, since essentially the beginning of 2023? What have I sold? How much have I contributed? You will be able to see all of that in real time as I do it. So that will be an extra layer of transparency that I think you all will appreciate. Again, if you want access to the CoveredCall ETF AllStar tracker, if you don't know what it is, it's a filtered list of all the CoveredCall ETFs out there. There's so many out there, but I'd try to keep. There's over 250 funds out there. So there's a US tab, Canada tab. Soon there's about to be a Jordan's portfolio tab, Jordan's trades tab. You can access that in my portfolio through either the full tracker membership or partial tracker. So partial tracker will get you access to these 4 right here. Currently it's just these 2, but I'm going to add these 2 tabs into the partial tracker. And if you want these other tabs as well, like the yield tracker, AUM tracker, average volume tracker, distribution tax tab, delist tracker, distribution history, distribution track. There's so much information here, and I also have videos in my Patreon that go through how you can filter through this, how to make sense of all this. But again, the more time you look at it, the more it starts to click and make sense. Going back to the original question, now that we're getting a little long-winded here at this point, I would say that, like you, Hamilton, travel, golf, cigars, Coronas, all that, I can't wait for. It's not like just working endlessly is my end goal. That's not. I'm actually taking steps, even right now, to experience what that kind of lifestyle is going to look like. I plan to take 5 weeks off this year, starting December 1st. I'm going to be taking the whole month of December off, the first week of January off, and honestly it's a bit of a micro trial of what financial independence might look like. Like, how will I react to essentially a day where I choose for myself, and to be able to spend more time with family, be able to work on the channel a little bit more, develop other videos, maybe connect with other creators, other fund managers, whatever the case is. It gives me a much broader opportunity to experience that. And then, especially for next year, I'm looking at, again, with the whole idea of less is more, like selling my place, getting into a house rental, because there's no way my current income, there's no way I can buy a house, but I can potentially rent one using equity, put it into CoveredCall ETFs, support the cost, to supplement the cost of that rental house and offset it. So for many of you, you've heard a lot of that before, but if you're a newcomer, think about subscribing, stick around for the journey. Hopefully these answers have satisfied most of your questions. I got myself a cigar here, Hamilton. I've had this since I was 17. I found it in a 1987 Oldsmobile Cutlass Calais. It was the first vehicle I ever owned. It was a rusted piece of junk. I only ever drove it once, but I found this in there. Never. Maybe maybe I'll smoke it if the day comes where I find I can achieve financial independence. But no specific rush at the moment. Planning on doing a little bit more traveling next year. So, just experiencing aspects of financial independence, even though I'm still working, but taking more time off, and, not absolutely putting away every dollar I possibly can, also striking a balance to use that for family, to travel, and just spend more time with family. Like that's absolutely in the cards right now, and I'll talk about it more in time. So hopefully y'all liked my answers. Again, sometimes I can get pretty long-winded with a lot of this, but I'm just excited, motivated, and just encouraged to talk about all this and give you all some ideas about what this whole covered call ETF thing is all about. So if you haven't already, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.